Okay, in this video we're going to look at how businesses record profit and loss and what it actually means to record a profit or to record a loss. So you'll have noticed in the last video we looked at a lot of transactions where we were either buying equipment, or we were paying off loans, or we were paying off debtors, or the owner was contributing capital, or the owner was withdrawing money for the business. None of these transactions, and I repeat, none of these transactions that we looked at in the last video actually affected the profit or loss of a business. Okay, none of these transactions were examples of what we call revenue or expenditure. And we're going to look in this video of what's meant by revenue and expenditure and how to actually calculate profit or loss for a business. So the profit or loss statement reports on the revenues and expenses of a particular business. And the profit is equal to the revenue of a business minus the expenditure. Okay, so the key thing is that not every time we receive cash is an example of a revenue, and not every time that we pay money is an example of an expense. So for example, if we receive cash because we take out a loan, that's not an example of revenue. Okay, if we pay money because we purchase new equipment, that's not an example of an expense, and I'll explain to you why in a second. So the definition of revenues is any inflow of economic benefits, not just cash, so when we sell something or provide a service. So the idea of a revenue is that it leads to an increase in our assets, or it can help to decrease our liabilities, which we'll talk about in a sec. And basically all of these transactions will increase the owner's equity of a business, or the owner's share of a business, but it doesn't include just money capital contributions by the owner. So it's any inflow of economic benefits when we sell something or provide a service that increases our assets or decreases our liabilities, but it doesn't include capital contributions from the owner. So for example, here's two examples. If you provide a haircut for cash, or if you provide a haircut on credit, so you're a hairdresser, which asset goes up? Well, if we provide a haircut for cash, then the asset cash will go up because we're going to get cash from that customer. If we provide the haircut on credit, then we're going to get a new asset called debtors for whoever we gave the haircut to, because they're going to owe us money in the future. So the asset cash goes up, or the asset debtors goes up, but it doesn't have any impact on our liabilities. The only thing that goes up is the asset cash or the asset asset debtors. So in this case, the business is now worth more to the owner because the assets have gone up, but liabilities have stayed the same, and therefore the owner's share of the business has increased. So that was what we call there's been an increase in revenue, which increases the owner's equity of the business. When the debtor pays you back, that's not an example of revenue, because what will happen is your cash will increase, so your asset cash increases, but your asset debtor goes down, so overall your assets stay the same, and therefore your assets are not increasing, and therefore it's not a revenue. So here's an example. When you provide a haircut on credit, asset debtor increases $500 because they owe you money. There's no other effect on assets or liabilities, therefore owner's equity must go up to keep both sides in balance, and therefore that would be an example of a revenue. Okay, so in this case here, you would have an increase in the bank account on this side. These are different figures, so ignore the actual document, but your bank would increase 50 if we got the customer paid in cash. In this case here, they've done it on credit, so it would actually be an increase in debtors, and this one doesn't have debtors, so you would add debtors, and that would be $50. And then at this point here, you'd have another transaction on this side where our net profit increased. So net profit would increase on the right-hand side by the same amount, $50. When the debtor pays you back, asset debtor decreases $500, asset cash increases $500. So overall, there's no impact on assets because one goes up, one goes down. There's no effect on liabilities, and therefore owner's equity stays the same. This means that it's not a revenue. The definition of expenditure is any loss of economic benefits that causes our assets to go down or increases our liabilities, and therefore leads to a decrease in owner's equity. And it doesn't include drawings or the owner withdrawing money from the business. So any loss of economic benefits that reduces asset or increases liabilities that overall decreases owner's equity. So let's look for an example. Let's say you pay rent for a period. What asset will go down? Well, if I pay rent, then I'm going to have less cash, so my cash would go down. So assets are going down on one side. Does it affect my liabilities at all? No, it doesn't, because I don't have any changes to any loans or anything like that. I've just given someone cash. So my asset cash goes down, so my owner's equity must go down as well to keep the transactions in balance. When you buy a computer for cash, your asset cash goes down, but this isn't an expense, and this is where it hopefully starts to make a little bit more sense, because the asset computer would go up. So in the first example, while your overall assets has decreased because you've paid rent, in the second example, your overall assets have actually stayed the same because you've got less cash, but now you've got a computer. So in the second case, when you're actually buying a product that you're going to keep, it's not an example of an expense, because even though your asset cash goes down, another asset will increase, and therefore overall your assets stay the same. When you pay money back to a creditor, okay, again your asset cash would go down, but on the other side of the balance sheet, the asset creditor would also go down. So assets and liabilities would be equal, so owner's equity doesn't change, therefore it's not an example of an expense. Okay, so when you pay your rent, asset bank decreases $500. It doesn't affect assets or liabilities in any other way, so owner's equity must decrease, and therefore it is an expense. When you pay back a creditor, again your bank decreases by $500, but the difference is in this example, your liability to the creditor, so on the right-hand side of your balance sheet, also decreases. So assets and liabilities have both decreased, and therefore owner's equity stays the same, and it's not an expense. When you buy a computer, your asset bank decreases $500, but your asset computer increases $500. Overall, there's no impact on assets, there's no impact on liabilities because you don't owe anyone any money, you paid for it in cash. Owner's equity stays the same. This is not an example of an expense. Okay, so here's some examples of revenues and expenditures from a business. Anytime a business sells stock or provides a service, so for example, if you're a tutoring business, you provide a service of tutoring, that will cause your revenue to increase. Any money you receive from selling TVs, for example, if you were selling TVs. If you were a plumber, any revenue would be from providing your services as a plumber, so fixing somebody's toilet, fixing pipes, drains, etc. If you're a builder, it would be from your regular just job of building products. In terms of expenditure, okay, things that are going to cause your cash to go down generally, but won't cause liabilities to go down as well. So for example, when you pay wages, cash goes down, but your liabilities stay the same. But if you paid off a loan, that would cause if you were to pay off a loan, then that would cause your cash to go down, but would also cause your liability loan to go down. So that would be an example of it would not be an example of an expense if you paid off a loan, because both assets and liabilities both go down. When you pay rent, when you pay any expenses on your car, any telephone expenses, insurance, etc., will all lead to having less cash, but won't affect your liabilities, so they're all examples of expenditure. Okay, so if we look at examples, which one will affect the profit? So which one's a revenue or expenditure? If the owner contributes capital, okay, that's not revenue or expenditure, that's an owner's contribution. If there's an increased bank loan by $2,000, so what would happen is your asset cash would go up by $2,000, assuming that you're using the money for cash, and your liability bank loan would increase. Both would stay the same, and therefore it's not an expense or revenue because both assets and liabilities have changed by the same amount. You receive $1,000 from your debtors. Your asset debtors goes down by $1,000, but your asset cash goes up by $1,000, and therefore assets stay the same. It's not an example of a revenue. If you borrow money from the bank to buy stock worth $3,000, okay, you're borrowing money from the bank, so you got a loan, which causes your liabilities to go up, but your asset stock also goes up, so they both stay the same. It's not an example of an expenditure. You use cash to buy a new computer. Your asset computer goes up, your cash goes down, assets stay the same. This is not an example of an expense. You pay $1,000 cash to existing creditors. Your asset cash goes down $1,000, your existing creditors goes down $1,000, so your liabilities go down. Both are going down by the same amount, and therefore that's not an example of an expense. You receive revenue of $400 for providing a service. Okay, that will cause your cash to go up by $400 if you get it in cash. Your liabilities won't change, so that is an example of a revenue. You pay the electricity bill, your cash goes down by $80, doesn't affect your liabilities. Okay, therefore your owner's equity would go down. That would be an example of an expense. I'm not going to worry about the last one in this video. Okay, the profit of a business is the revenue coming into the business from selling goods or services less the costs, for example, all their expenditure. So it would be all the money from providing your service minus all your expenses for electricity, advertising, stationery, etc. It doesn't include anything like paying off a loan or buying a computer or anything like that. Okay, this is what a profit and loss statement looks like. You've got all your revenue at the top, then all your expenditures, and this amount, this profit, will go into your balance sheet underneath the drawings amount to keep it in balance. Thank you.